7 days ago, most Australian economists were expecting the Reserve Bank to lift interest rates by 25 basis points next month. Since then, we've had cash rate rises in the US and the UK, and the word recession is rearing its ugly head again. As of today, a majority of these Aussie economists are now expecting 50 basis points in October. Here is Jerome Powell, the chairman of the US Federal Reserve, talking recession risk.
For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be.
Joining me now on the set is Richard Yetsenga, Chief Economist at ANZ Bank. Richard, thanks for your time today. What are your expectations for the Reserve Bank's board meeting in October? Will we see 50 basis points?
I think so. Unfortunately, I think we'll see a continuation of the run of 50 basis point moves. The bank's spoken recently about maybe slowing down, but I think the strength in some of the survey indicators particularly, which suggests the economy is still running really, really well, and in fact, almost anything outside the housing sector is saying the rate hikes we've seen to date don't seem to have appreciably slowed activity, and so are unlikely to have affected businesses' willingness to pass cost increases through. I think we'll see 50.
A couple of weeks ago, a lot of economists thought it'd be 25. Now it seems to be 50's the consensus. What's changed?
Oh, it's been a flipathon this year, to be fair, over a lot of these meetings, because obviously, as always, we're not just trying to pick what we think the central bank should do, but also what they will do. And so their communication, I think, the bank's communication has moved around a bit this year, as they've also got their hands around, the big changes in economic conditions we've seen as the year's gone on.
We've heard from US Fed Chair Jerome Powell this week, and he started talking about the possibility of a recession for the United States. Is this a big admission from Jerome Powell?
I don't know whether it's a big admission. It's been for quite a few quarters, actually, in financial markets and the popular press. The recession word has been around. I think it's sensible the central bank deals with that head on and talks about it. The unfortunate reality is by leaving interest rates at their most stimulatory level until so far into the recovery, it does raise the risks that there's a policy mistake in terms of tightening too far, because you're trying to move at the same time as trying to reassess how much impact your tightening has had.
And Powell's flagged a potential correction for the property market in America, and it looks like there's quite a few similarities between the US and Australia with property. How much of a risk is this for us?
Property is the obvious sector, I think, that responds to higher interest rates. Certainly it affects borrowing capacity. If you think about the way mortgages are offered in Australia, an increase in interest rates mechanically flows through. All other things being able to the size of the mortgage you will be able to get, and it makes sense, therefore, that the property market comes off. Market's weaker in New Zealand, the market's weaker in the UK. I think that's a pretty consistent story. It's the rest of the economy often which is holding up better than forecasters expected.
And then also this week we heard from the Governor of the Bank of England, Andrew Bailey, and he said the UK economy, the British economy, is in recession. It's more due to high inflation and high energy prices. But how much of a risk is this for our economy here?
I don't think there's any direct impact from the UK to Australia. I mean, the UK, obviously, there's this small issue of Brexit and difficulty with trade supply chains and other things, which is causing a bit of a problem literally on the other side of the world. For Australia, it's, I think, unarguable that the risks around the economic cycle go up as interest rates go up. They're probably a bit more acute this cycle because central banks have left it so late to hike. But our central view certainly is the property sector weakens, the rest of the economy weakens, but at the sort of interest rate levels that are within the market's frame, so somewhere between 3 and 3.5% as a peak interest rate, I think the risks of recession are not that high in Australia.
One phrase we've started hearing a bit more of recently is the wage inflation spiral. How does that actually work?
Poor terminology, to be honest. It's probably the first thing I would say. I mean, how does it work? Inflation pressures wage earners, they demand higher wages, which forces up inflation, which means wage earners demand higher wages. There's very little sign of that in Australia, if in fact any signs at all. In fact, I would argue if you look at the wage price index, which measures wage rates in the economy, we can get some higher wage growth still without being a medium-term threat to the Reserve Bank's inflation target. The biggest threat is just the demand for resources in the economy is too strong, growth is too strong, it's above potential. The RBA bringing that back to potential, I think, will sustain the cycle for longer.
So do you think that term wage inflation spiral, wage price spiral, has been overhyped a bit too much?
In Australia, it's all smoke and no fire.
This week we also heard from RBA Deputy Governor Michelle Bullock. She talked about the bank's bond buying program, $280 billion in bonds over the course of the pandemic. That looks like they're going to rack up some big losses over the next few years. Is that an issue at all?
Look, it's not something that occupies my mind a lot when I think about monetary policy and the economy. Most things cost something. Most policy choices cost something. I think when we consider what was in most of our minds in March and April 2020, $10, $20, $30 billion doesn't sound like a lot to rescue a $2 trillion economy.
Next week we're going to get the CPI numbers for our economy, and we heard Michelle Bullock as well in a speech suggest inflation could actually get to 8% this year, potentially early next year. That sounded like a new admission from me this week. What are your tips for inflation for the rest of this year?
Oh, that 8% is a new number. We have a forecast in the sevens. Most people, I think, are in the sevens. The bank in their published forecast seems to be consistent with that sort of number. I'm worried less about the peak, to be honest. The question to my mind all the way along is focusing on the peak gets you thinking about the wrong things. I think the question really is, where do interest rates need to be to bring inflation back to target and keep it there on a sustained basis? And I think where they are in Australia at the moment is still too low.
Yeah, when are we going to actually see that big impact from these rate increases on mortgage holders? When are we going to see a crunch in people starting to stop spending as much money as they currently are?
Well, of course, for businesses, retail sector businesses, they're quite happy that consumers are continuing to spend. We have seen a bit of a shift away from discretionary spending as people's interest bills have gone up, and of course, as energy prices have gone up, and that's taken a larger share of people's income. But also it's worth remembering that the housing sector in Australia came into this tightening cycle perhaps with the best balance sheet conditions we've seen in 15 years, perhaps longer. That means it's going to take a little while for that effect to show up.
Another thing's been high energy prices due to the war in Ukraine. That looks like it's not stopping anytime soon. So how much pressure is that going to continue putting on Australian consumers and inflation?
Well, in fact, global oil prices have come off a reasonable amount, more than 20% from their highest levels, but the Aussie dollar has also gone down. So in Aussie dollar terms, we haven't seen the benefit of that. And this is part of, I think, where the Fed's tightening cycle is complicating the task for other central banks like the Reserve Bank of Australia, because it's driving the currency down, which is adding a bit of inflation at a time we could do with some efforts going the other way.
Yeah, the dollar's almost at near 2-year lows or a bit over that. So what are some of the risks for us with the dollar being at that level?
I don't know that the risks are that big. And in fact, in trade-weighted terms, if we try and take out the influence of the US dollar, which is pretty rampant at the moment, the Australian dollar has been much more stable in trade-weighted terms. So a lot of what you're seeing in Aussie weakness is US dollar strength, but it does add to inflationary pressure to the extent a lot of Australia's imports are priced in US dollars, and we get that currency translation, which is tending to keep prices higher than they might otherwise be.
Richard Yetsenga, Chief Economist at ANZ Bank, thanks for your time today.
Thanks very much.